Hello and welcome to this program from Baillie Gifford, the latest in a series of webinars where we talk to the managers of the business's different investment trusts. Today we are talking to Gary Robinson, co-manager of the Baillie Gifford US Growth Trust. My name is Jeremy Gordon from Citywire and I will be talking to Gary about how he runs the trust for about 25 minutes. Gary, great to have you on the program today.
It's great to be here, Jeremy.
Brilliant. Well, thanks for joining us. Okay, so without further ado, I'll start on my question. So, the trust performed very strongly in 2024 after some tougher times in recent years. How would you sum up the year?
Well, it was a better year. In fact, we've had a couple of better years after what was quite a tough period immediately following on from COVID. The environment post-COVID was almost a sort of perfect storm for high growth investors, where you had lockdowns and stimulus driving inflation, which drove interest rates up, and which impacted the valuations of long duration assets. I think 2024 and 2023 as well. Those years for me represented sort of us getting past that period, and it's felt like we've been in more of a true stock pickers market again, where rather than stock prices being driven mostly by the macro and what Jerome Powell was saying from week to week, stocks are being driven more by the underlying fundamental progress at the businesses. So that's been great. And then in terms of the performance in 2024 for us, it was pretty broad based actually. It's difficult to call out specific trends. Nvidia was obviously a big positive contributor for us, but we had positive contributors in a whole host of different sectors. So DoorDash in food delivery, Sweetgreen in restaurants, Meta in advertising, Duolingo, the language learning app. So a real broad range of different names. On the negative side, it wasn't all great news. We had some challenges with stocks in 2024 as well. Moderna was a negative contributor to performance, where there've been some execution issues with the go-to-market, and then there were a couple of enterprise software stocks that were caught up in some fears around sort of implications of AI. So I put Workday and Snowflake into that category, but overall a very good year for the trust.
Okay, so back to something like business as usual. Maybe until this year, in early 2025, we've seen a fairly dramatic correction in the US market, centered on US tech names. And that's kind of speaking about before the tariff announcements, I'm sure everyone's seen. Well, 2025, what do you make of it so far?
I don't know what to make. Look, with regards to the tariffs, one thing that we agreed on as a team following the news of Trump's election to president was that there was now a wider range of outcomes for the economy and the stock market, because I don't think anyone really knew what his policies were going to be and how those policies might impact the market. What we've had so far has been a lot of flip-flopping on tariffs in particular, and measures of economic policy uncertainty are higher than they've been for a very long time. And that's starting to impact on consumer confidence and will impact on business confidence. And the probability of a recession has increased, although it's by no means a certainty, but it's higher than it was prior to all of this policy uncertainty. And then overnight we had the reciprocal tariff plan. I'm quite reluctant to say too much in the immediate aftermath of a big announcement like this. I don't think it's very helpful. I think it's better to take time to digest. To give you a bet on it, though, I think on the face of it, if you take it at face value, it's not good, right? So these tariffs in aggregate would be higher than the tariffs that were in place in the US just ahead of the Great Depression. They will impact on inflation. They will impact on consumers' purchasing power beyond that, with their impact on the stock market, So and they just create a lot of uncertainty. So um, I, the positive spin is, and I, I don't know whether the true state will be somewhere between the worst case scenario, which is that these are the tariffs and these are how they will be forevermore, and the positive spin, which is that actually this is just a starting point. It's a negotiating position for Donald Trump to seek concessions from trading partners, because as much as we talk about free trade, there isn't actually free trade between countries around the world. There are a lot of defensive measures in place in other countries in terms of exchange rate manipulation, quasi pegs, and tariffs to protect industries in countries in Southeast Asia, for example. And it might be that he's using these sort of shock tactics to try and bring some of those countries to the negotiating table to extract concessions, which would be very good for America's position in the long term. But I think we're just at a point where there's quite a lot of uncertainty with this right now. For us, we remain focused on the things we always focus on, which is, we're trying to find companies that have the potential to be much bigger in the future than they are today. And whilst like in the fog of war, like now it can feel like quite bleak. I think one of the important things to bear in mind is that the types of exceptional growth companies that we invest in, I think they're the sorts of companies that are very resilient and adaptable, and they tend to do well regardless of the economic backdrop. What's more important for them than the economic backdrop is their ability to execute on the large growth opportunities ahead of them. And I suspect even if you were to sort of take the last 20 years and you reversed who was in the White House in any 4-year term, we would have still seen significant upside from names in the portfolio like Tesla, like Amazon, like Nvidia. So, I think we can at times like this get over focused on what's going on with regards to economic policy, with regards to macro, with regards to geopolitics. But actually, given our style and given our bias for high growth companies, I don't think it matters as much for us as the stock picking itself.
Okay, that makes sense. Um, Chinese AI company DeepSeek rapidly came onto everyone's radar earlier in the year. When did you first hear about it, and how has its emergence affected your portfolio companies?
Yeah, I mean, we heard about DeepSeek. We've been following AI pretty closely, and we heard about DeepSeek before, maybe a month or so before the market reacted to the news of the R1 model, because DeepSeek had released a non-reasoning model called DeepSeek V3 ahead of that R1 model, and a lot of the innovations that were key to driving efficiency in that reasoning model were already present in that uh, precursor model that they released. So it felt to us like a bit of a delayed reaction from the market. And actually, I think it was probably a little bit of an overreaction. I think the most notable thing about DeepSeek is that it came from China. I don't think the fact that it was cheap was particularly notable, because the cost of AI models has been falling dramatically for years. The cost per token just keeps coming down, and DeepSeek was just a continuation of that trend. And there were other models that came out around about the same time that were even cheaper from Google. So I think all of the sort of the hand wringing over the efficiency gains was misplaced. But I think the main takeaway for me was actually China is going to be a serious player in AI.
Okay, but it means China will be a serious player. It doesn't mean a paradigm shift.
No, no.
Okay. Um, so the move to sell down your Tesla stake, which has been covered a bit more widely recently, it seems like quite a momentous moment for Baillie Gifford's US strategies and the wider firm, really. I suppose, how do you reflect on that, and what's the position size in the US Growth Trust today?
Yeah, like Tesla's one of 40 odd public holdings that we hold in the US Growth Trust and the American Fund. And I think, given the personality of its founder, it probably gets a lot more attention than its importance to our portfolio warrants. So, you know, Shopify has been a bigger holding for us for a long time in the US Growth Trust, and I barely ever talk about that one. But Tesla, you know, for obvious reasons, comes up a lot. Now we've reduced it. It's now 1.6% of the portfolio. A year ago, just to give you some context, about 6 months ago, it was about 2.8% of the fund. The reason we reduced it is it's sort of in the immediate aftermath of the election, the shares had performed very strongly. I think they were up about 50 or 60%. And you know, from our perspective, there wasn't any real new news on Tesla at that point. There was a sort of a lot of hand waving around, sort of, oh, this might clear the path for them to roll out their self-driving technology, but it didn't feel significant enough to us to warrant that massive rise in the share price. And so we used that as an opportunity to take a little bit of money off the table. We still own it. We're still, happy shareholders, and I wouldn't rule out us adding back to it at some point in the future.
Well, that makes sense. You mentioned Tesla's founder, which does lead me onto my next question. You know, at the same time, your top holding, SpaceX, seems to be going from strength to strength. I suppose, yeah, can you summarize the kind of bull case, but also the bear case for that investment, you know, whether people could be too excited? And I suppose, yeah, how you're thinking about Elon Musk and companies connected to him more generally today.
Yeah, I mean, SpaceX is the biggest holding in the US Growth Trust, and I'm happy about that because I don't think there's another company in our portfolio that's got a stronger competitive position than SpaceX. It is dominant within the space industry, and I don't use that word lightly. It is responsible for over 90% of the mass that's being put into orbit. And that's because SpaceX can do something that other companies can't do. It can reuse its rockets. And that's just made the industry so much more economical and efficient. And SpaceX has leveraged that efficiency to make its way into a massive market in the form of its Starlink business. So what Starlink does is it runs a constellation of about 7,000 low Earth orbit satellites, which are designed to deliver high-speed broadband just about anywhere on Earth. And we're pretty spoiled in the West. You know, most of us have got access to fast broadband, but there are actually a lot of places and a lot of situations where it's still difficult to get access to fast broadband. Even in America, for example, there are rural areas, and you know the Biden administration has committed $40 billion to trying to connect rural areas to broadband. There are rural areas that don't have fast internet. And then there are a lot of situations where we don't have fast internet, like if you're on a boat or if you're on a plane. And so there's a massive opportunity here for Starlink to fill an unmet need in the medium term. And then in the longer term, I could see this business potentially even competing with the legacy broadband companies. And that's one of the biggest market opportunities globally. So this is a big business. It's a profitable business. It's a fast-growing business, and it's one with an incredibly strong competitive position, a differentiated technology, and that enables it to do things that others can't do. What could go wrong here? Like with any stock that we invest in, there are lots of different ways it could go wrong. I think there's always risk around. I think there's technology risk. The company's developing a new version of its rocket called the Starship, which is where it's innovating in public, and we've all seen the sort of spectacular explosions of those rockets as it iterates on them and tries to perfect them, and that's the way that SpaceX works. But there's a chance that might not work ultimately. You know, I think we have confidence in the company given their track record, but and then there's risks with I guess the in terms of the very long-term opportunity for Starlink. it's competing in regulated industries, and there's a risk that you could see, particularly where national champions are at threat. Some of these countries acting in order to protect their incumbents from this new entrant. So.
Okay. And yeah, I suppose, and just to follow up on the point, yeah, I suppose, yeah, how you're thinking about Elon Musk companies in general, or is it more you think on a company by company basis?
Yeah, I mean, I've always been worried. I've always been a little bit worried that Elon Musk had too much on his plate. We've been invested in Tesla for over 10 years now. And even back then, we were worried that he had too much on his plate, and he's just continued to add more and more to his plate. And he's an individual who has a unique ability to sort of juggle multiple balls. And, the execution at SpaceX has been fantastic. And I think Gwynne Shotwell's been a big piece of that. His second in command there. With Tesla, there's a lot of debate right now about the weakness that they're seeing in car sales, particularly in Europe, and how much of what Musk has been doing with regards to his role in the US government is having an impact on the brand. I think it's probably a bit too early to tell what the long-term branding impact will be, even if it's having an impact on demand in the short term. What we also have to remember with Tesla is that and we knew this, we've known this for a while, is that they're in between a couple of major growth waves at the moment. And so, they had the mainstream products in the form of the Model Y and the Model 3. Those products are reasonably mature now. I mean, they've updated them, but they are relatively mature mass market products. And then, they're going to go into volume production with their next product, the Robotaxi, next year. But so we're in that sort of in-between moment right now where they haven't actually had a mainstream. They launched a Cybertruck, but that's a pretty niche product. But they haven't had a mainstream product release in a long time. And so maybe maybe there are some impacts on the demand from what's been happening with Doge, but maybe also there's an element of product cycle in that as well. And the refresh will be helpful on that front.
Okay. On to another very well-known company. Nvidia is a top 10 holding for the trust, but by no means a huge position after you took profits last year. What's your view on it today?
Yeah, it's so Nvidia is sitting at about 2% of the trust, at least at the end of February. We're still optimistic on Nvidia, but we think the upside case is just more challenging from here. And that's partly just maths. So the company's a lot bigger now than it was a few years ago. A lot bigger than when we first invested back in, before we've owned this in the team's portfolios since before the trust even existed. And today the market cap is $2.7 trillion. And we're looking for significant upside. That's a key part of our philosophy. And it's just a lot harder to see significant upside from a $2.7 trillion market cap than from a $100 billion market cap. So that's one factor that's playing into position sizing here. A second factor is just, I think there are some subtle changes underway in the AI industry that I think are at the margin opening up NVIDIA to a little bit more competition. So when the market was mainly about training AI models, that's a use case where NVIDIA has a virtual monopoly. Its chips are very, very good for training. But we're now shifting to a world where actually the inference part, so training is use of computation to make the models at the start, and then inference is the compute that you use to run the models after they're launched. And increasingly that's being used also to help the models think in response to queries. There, NVIDIA's stranglehold is not as great. And we're starting to see some of the hyperscalers and some of the leading labs look to alternatives like Amazon's Trainium 2 custom ASIC or Google's tensor processing unit for some of those inference workloads. So there's a little bit of competition at the margin. I still think NVIDIA is going to grow from here. There's insatiable demand for compute, but the case isn't as clear cut as it was a couple of years ago.
So a third of your portfolio is in private companies, roughly. Other than SpaceX, can you summarise some of the major recent developments there?
Yeah, so I mean, SpaceX is a big part of that private
A
allocation.
third of that third, roughly.
A third of it, yeah. It's our biggest holding. It's like 11% now, partly because it's just done so well. And then the next biggest, two of our top 10 companies are private companies. So SpaceX is one, and that's the biggest holding. And then the other one is Stripe, which is 5% of fund or thereabouts. So between the two of those, you're getting on for at least a third, maybe closer to half of the private allocation. And yeah, I mean, there are limits to what I can say publicly about private companies because we're under NDA with a lot of them. But Stripe helpfully published a public annual report recently and gave some stats on it. And so, that's a business that just continues to go from strength to strength. So Stripe is a payments platform that's used to make payments online. It's very widely used. They've created a super easy to use platform where you just plug in with a few lines of code, and then you're able to seamlessly move money around the world, which was a very difficult thing to do going back 10, 15 years. And then they've also built out a series of SaaS modules on top of the payments platform in areas like, for example, billing, fraud, marketplace, for example. But one of the things I wanted to highlight with Stripe is just like how massive a business this is in economic terms, because I don't think that's widely appreciated. So in 2024, Stripe processed $1.4 trillion of payments, and so that was up about 38% year over year. And so Stripe now accounts for 1.3% of global GDP. And the company was also, like SpaceX, was profitable in 2024. And so I think this is something that you have to bear in mind when you're thinking about our private company allocation for US Growth Trust. Some of the companies that we own are quite early stage. We own a quantum computing company, we own a drone company, but we also have big holdings in big companies that, if they were public, they'd be some of the biggest companies in the world. But they just happen to be private because these are companies that have chosen to stay private for longer. And one of the challenges that investors face today with investing in America's innovative growth companies is a lot of the most innovative growth companies have chosen to stay private, and it's really hard to gain access. Like, it's fine if you're a wealthy individual or a venture capitalist that's networked into the innovation ecosystem. But for the average investor, it's really hard to gain access to these companies, particularly cost effectively. And I think that's something that you get with the US Growth Trust that makes it special. It's cost effective access to exceptional US private companies like SpaceX and Stripe.
Your trust was, of course, a target of the US activist firm Saba Capital. How was that experience, and what do other shareholders need to know about the situation today?
So Saba requisitioned a meeting to replace the board and ultimately replace the manager. And that requisition was voted down by shareholders. So I think something like 98.5% of non-Saba shareholders voted against Saba's proposal. So I think what we can conclude from that is that there isn't a huge amount of support for what Saba proposed, and certainly the feedback that we've heard from many shareholders in the trust is that they are committed to this mandate, that they bought this trust for a reason, the reason that I just mentioned with regards to sort of private company access. And they want to see the trust continue in its existing form. I think one thing to say, like we we have a difficult balance to strike with this vehicle because on the one hand, we want to ensure that it's trading as close to NAV as possible. In an ideal world, the trust would trade at NAV. But on the other hand, we have a very significant allocation to private companies here. 35% plus of the portfolio. And so when we buy back, that is a capital allocation decision that impacts on our private weighting, all other things equal. And, as I say, we're over 35% now. When we buy back to defend a discount or for any other purpose, we're driving up that private weighting. And some of our shareholders have expressed concern with that private weighting going significantly higher than where it is today. But we're always keen to hear feedback on that. And if any shareholders on the call today have a strong view in that, we'd love to hear your views.
Back to tariffs potentially. How much of an issue is potential boycotting of US global brands by consumers around the world? And to what extent, would you preempt that possibility by reducing positions in US consumer brands?
Boycotting them in response to the tariffs?
Yes. Or I suppose, yes, tariffs and all of the above in terms of the new Trump administration.
Or, the Tesla one.
Right. They haven't specified that, I'm afraid.
Yeah. Okay. Yeah. I mean, I think like in the short term, that sort of thing can drive volatility and headlines. But I think in the longer term, consumers have a tendency to buy the products that add the most value for them. And so I'd struggle to see that representing a major headwind for companies that are producing valuable, differentiated products. I think if you are in the business of producing commodity products where there are readily available substitutes, then that sort of thing is a very real risk because there's no differentiation, and consumers are not actually faced with any switching cost or pain for going to the alternatives. But for companies that have a different, and that's what we're trying to invest in. We're trying to invest in companies that have differentiated products rather than companies that have commoditized products. I think over the very long term, I don't see boycotts having a major impact on those types of businesses.
Okay. I'm going to try and combine two questions into one here. One question is, might SpaceX ever IPO? And then someone else asks, yes, they say, they've heard something about Starlink potentially being spun off and listed as a standalone business. Yeah, can you comment on that possibility as well?
I don't have any insight into the timeline to either a SpaceX or Starlink IPO beyond what's been said publicly. They're not under any pressure to IPO. The company doesn't need vast quantities of capital. Elon Musk has said in the past that he would think about taking Starlink to market when it was profitable. But we haven't heard anything on that for a while. So it would be great because we'd love to own SpaceX for a wider range of our clients. As things stand, we can only own SpaceX for the clients that invest in our vehicles that can invest in private companies, which is a very small percentage of Baillie Gifford's assets. And I think this is as I mentioned earlier, one of the most attractive growth companies in the world. But if I was to speculate on it, I'd say and this is pure speculation, it's not based on any inside knowledge or insight. I think it's quite unlikely in the next year, but a spin out of Starlink is quite likely in a 5-year view.
Right. Okay. All right. I suppose, yeah, when you have such big companies like this, is a public flotation inevitable at some point, or could we really be entering a new world where companies stay private, become giant, and stay private?
Yeah, I mean it's interesting. Like so long, it's the big issue that some of these companies have run into is tax, right? So Stripe's had that where their employee share options are maturing and crystallizing significant tax liabilities for employees, and then so they need to create liquidity for employees so they're able to pay those tax liabilities. But Stripe has managed to do that through multi-billion-dollar tender offers in private markets, and for as long as they continue to be able to do that, and there have been no signs that that ability is sort of waning, then they can stay private for as long as they like. The thing is, the frustrating thing from a sort of public market investor standpoint would be that it's the best companies that get to stay private for longer, because there's tons of demand for the shares from private investors. So they don't need to worry about going to public market. There's also those companies are the ones that don't need as much capital because they're great businesses. Stripe mentioned that again, his annual report is profitable. It's free cash flow positive, so it doesn't need the money anymore. So, um, I think Stripe would like to be a public company at some point. It's probably helpful at the margin from the perspective of Stripe is I'm answering on Stripe rather than SpaceX, but Stripe is moving in its payments business up market and signing bigger and bigger enterprise contracts. And I think the danger when you're starting to go, so Stripe's sort of core customer initially was it's sort of Silicon Valley type startups and then tech companies, and they all know who Stripe is, right? If it's a private company. But once you're getting into the territory of sort of like providing payments to legacy enterprise scale businesses, and you turn up as Stripe, they might not know who you are, and a public offering can help with that and give a little bit more comfort because there's visibility into the financials. So I think there's some pressure, but it's not a great pressure. So
Okay, some interesting thoughts there. One question here is that the viewer asked, you said over the long term you expect the companies in the portfolio to do well irrespective of economic conditions, but you also said that in 2022, early 2023, interest rate rises dealt a big blow to your companies. So yeah, can you kind of explain that a bit more?
yeah. Well, I mean, I think that if you look at the data, and we put this in our presentation materials, uh, over periods of 5 years and longer, there's a very strong correlation between sales growth and share price performance and earnings growth and share price performance. So the bottom quintile on earnings growth and the bottom quintile on sales growth, over a 5-year view, the bottom quintile on share price returns, and the top quintile sales, top quintile earnings, or the top quintile on share returns. So yes, during the COVID period, there was a lot of volatility, and you got to remember that there was a lot of strength and then a lot of weakness, and through that COVID period, in a short space of time. But when you look at over 5-year periods, there's a very strong correlation between underlying fundamental progress of the businesses that we invest in, and the share price outcomes for these companies. So long as the profit growth comes through over the long term, then we're confident that share prices will ultimately follow. Now, what I'm trying to say with this is that the economy can matter at the margin. It can impact on the pace of sales and earnings growth. But for the high growth companies that we invest in, the structural growth often overwhelms that. The shift in Amazon's case from offline retail to online retail, the tailwind that provides is much stronger than any potential economic headwind, so long as you stretch your time horizon out far enough. And so there are going to be periods of 2 or 3 years where performance of where share price performance and fundamentals become detached from one another. And COVID was the most extreme example of that I've seen.
In your favor, perhaps.
So far, yeah, exactly. But over long periods, these things tend to line up, and that's what we're trying to do. not predict share prices, but predict fundamentals, and trust share prices will follow.
Yeah, what downside protections do you try to build into the portfolio?
The downside protection in terms of,
I suppose trying to protect from significant drawdowns in portfolio value.
yeah. So let me just say that the volatility that we saw during and after COVID was higher than we expected. And, we would prefer for this portfolio to not deliver those levels of volatility again in the future. As I mentioned, it was almost a sort of perfect storm for growth investing, in the sense that we had a very rapid change in real interest rates, and a sale in a broad-based sell-off in high duration assets, like growth stocks. So it would have been hard for us to protect against that completely, without changing our style. The main issue we had in the post-COVID period was that we were high growth, and we're committed to remaining high growth. And I think it was very difficult to predict what was about to happen at that point. No one thought that inflation, well, certainly none of the macroeconomic forecasters thought that this was going to happen. And we're not macroeconomists. So it's very difficult to predict. Having said that, I think we made a mistake in allowing the portfolio to become too imbalanced. And we allowed, the portfolio to shift too far towards early stage companies. That was partly due to some of the early stage companies that we owned in the portfolio performing very well, very fast. And it was also partly due to us sort of compounding that error during that period and adding some new early stage companies to the portfolio, and funding those out of reductions to more enduring type businesses like Alphabet and MasterCard. In terms of going forward, so the listed part, the unlisted piece of the US Growth Trust is illiquid, which makes it difficult to manage actively, because we can't just go out and sell positions very easily, particularly when we're in volatile market conditions, because we wouldn't realize good prices and it wouldn't be in shareholders' interests. But we're able to manage the listed part of the portfolio more actively. And we with the listed part of the portfolio, we closely mirror what we do with the American fund. And what we're doing on the listed side now is we're being much more proactive in monitoring the percentage of the portfolio in early stage businesses versus the percentage of the portfolio that we have in the enduring growth businesses. And we're ensuring that we strike a balance between those on an ongoing basis. We're also, we have a 5-year time horizon. We tend to react quite slowly, and that's by design. We're trying to capture upside, and I think it's better to be, in that scenario, it's better to be too late to sell than too early to sell, given our philosophy and what we're trying to do. But we do recognize that, during that COVID period, things just moved so quickly and we should have reacted faster, and we need to be a bit more nimble. So we've put in place a new process step whereby if any stock moves 2.5 times from our last review, if the share price goes up 2.5 times, it's an automatic re-review. And we've done, so we introduced this about 6 months ago, and we've already put a number of different stocks through this process. So Nvidia was one, and we actually reduced on the back of that process. Sweetgreen went through that process. We decided not to do anything. I think Cloudflare went through that process, and we decided to add. So it's not always a guarantee that we're going to reduce when something goes up 2.5 times, but we are being more cognizant of these short, sharp share price moves and more nimble in response to them.
Okay, that's very interesting to hear. Next question. The person asks, were you offered or did you take part in the recent funding round into private company OpenAI?
We're very interested in OpenAI. We um, I, we're following it closely. We've spoken to the management team. It's a very complicated business. It has a very unusual organizational structure. Um, not for profit at the top. It's a limited liability company. Um, there are some complexities with that one, which the company is trying to resolve. And if they were to resolve those complexities, that would make life a lot easier for us.
Okay. And next question asks, which are some of the small public companies in your portfolio that have the highest potential?
Small in terms of percentage holding or small in terms of market
I
cap?
took it to be small in terms of market cap.
Small in terms of market cap. Gosh.
But if it's easier, feel free to say small holdings, which could, which you're most excited about.
No, I'll have a look at the list and see which ones sort of jump off the page. So some of our biggest holdings are pretty big. Amazon and Meta and Shopify. Cloudflare. I mean, I don't like Cloudflare is a sort of tens of billions of dollars of market cap. I don't know if that would count as one.
In the
Smaller.
US, that counts as a mid cap, doesn't it? So yeah.
Okay. Okay. I'm very excited about Cloudflare. So Cloudflare runs a network of like around about 200 basically local data centers that were built originally to sort of provide security for websites. So it has this unique distributed global IT infrastructure at the edge. And the company's been really smart in continuing to build new products on top of that infrastructure, and sort of get the most leverage out of that infrastructure. And one of the very new products that's gaining real traction is that they're now offering the ability to run inference AI workloads on its edge network. And that's something that I think is really exciting because there are certain, what I would describe as quite chatty AI workloads, like self-driving, for example, Internet of Things, where it makes a lot of sense to actually run your AI models on the edge, but where the ultimate edge, the device, the car or the mobile phone, is just too small to do that. So the two extremes are on the device or in the data center. Cloudflare offers an intermediate solution where you can actually run the model in these sort of edge locations much closer to the end device, and it's much more efficient. And there are other reasons why it makes sense to do inference compute. But I think inferencing compute is going to be absolutely massive. This is something that's become more apparent post the release of some of the newer AI models, the reasoning models. The old AI models, most of the compute went in at the point of training, and then the models were launched and you queried them and they would give this sort of next word in sequence sort of response. Now the newest models, these reasoning models like R1 with DeepSeek or O1 from OpenAI, they think post query. So they're actually, instead of just giving you an intuitive answer based on their training, they will actually explore different chains of thought and then pick the best answer after exploring different chains of thought. And that's highly computationally intensive, that process. And so the demand for inference compute is exploding right now on the back of these reasoning models. And so I think that there's going to be an insatiable demand for compute over the next 5 to 10 years as these models continue to roll out.
Can you say anything more on the options to deal with Saba, or how the board is approaching the Saba situation?
Yeah, I mean, our board, all of the options are on the table. All of the different options are being considered. Our board are very focused on finding. Let's see if our board are very focused on making sure whatever they do is in the best interest of all shareholders. It has to be right for everyone, and they've been speaking to some of our larger shareholders to get feedback on how they're thinking about the trust at this juncture. So that's all I can say on that at the moment.
Can you discuss buybacks a bit? And this person, the viewer says, I know you have the private company exposure. but why can't you set buybacks to defend the discount at a certain level or something like that?
Yeah. So the unlisted exposure, um, uh, the unlisteds are above 35% right now of fund, and we have a limit of 50% at time of purchase. And the feedback that we've had from shareholders is that they don't want to see some shareholders, not all, but some shareholders have that they don't want to see the percentage in unlisteds go much higher um, than it is today. So when you buy back, you need to find cash to fund the buyback. Now, we don't hold a big cash balance in the US Growth Trust. And so in order to buy back shares, we need to sell securities. We have public securities and we have private securities. It's hard for us to sell the private securities. A lot of the private companies that we invest in come with transfer restrictions on sale. So the straightforward option for us to fund a buyback is to do it by selling down the public companies. So when we sell public companies to buy back stock, what you do is you reduce the amount in public companies, your amount in private companies stays the same, and your private percentage goes up. And as that private percentage goes up, it reduces our ability to do private company deals in future. And so that's a capital allocation decision that the board has to think about. Do we want to be spending our capital on buybacks or private companies? Because you cannot do both indefinitely. What would be really helpful would be for the IPO market to come to life. One of the challenges we've had with the unlisted weighting is just that the IPO market's been dead for 3 years, and so in a more normal environment, you would have turnover of new private companies coming into the portfolio, and then some of our private companies maturing and becoming public companies, which solves. And that was the situation for the first 3 years of the trust existence. We had inflow and outflow from the private company bucket. Now, like, we've had no outflow apart from one, like Oddity, the cosmetics company that we own now as a public company. That would be, but I don't have a strong sense for the timing of that. Like, a lot of people were saying, this was the year, second half, that we were going to start to see more activity in the IPO market. But given what's going on right now with economic policy and the uncertainty that's being created on the back of that could delay that. So yes, we can do buybacks. Yes, we have been doing buybacks. We bought back a significant percentage of the company last year, but we have to think about the balance between capital allocation to buybacks and private company allocation, and how much we want headroom we want to retain for supporting our existing companies when they need cash, and also for investing in new opportunities as those arise.
Okay, well, look, that brings me on to what is actually the last question, another feature of the investment trust structure, gearing. So gearing stands at about 4 or 5% today. How should we interpret that?
So again, this is something just like buybacks. Buybacks are for the board. Gearing is another matter for the board. Just to maybe give you some sort of thoughts on it. We never want this investment trust to be put into a position where it's being forced to sell. So we've managed the gearing quite conservatively historically. I think it's currently low. One of the things that we look at quite carefully when we're thinking about gearing is just what are the sort of covenants that we're being asked to sign up to when we're taking on additional debt. And those covenants will have sort of triggers associated with sort of minimum net asset value and that sort of thing. And when we first took on debt for the trust, those covenants were fairly, they gave us a lot of flexibility. When we've looked more recently, the covenants have been a bit more stringent. And so we're just trying to find the right balance between, I think in a long-term orientated equity portfolio, it makes sense to have some gearing. You expect your equities to do better than the cost of debt financing, but you never want to, you never put the trust into a position where it's going to be forced to do something that it doesn't want to do at the wrong time.
Okay, well, look, that was our last question. So thank you, Gary.
Thank you very much, Jim.
Right, that's all we've got time for today, I'm afraid. Thank you again, Gary, for your time and insights. And thanks to you for watching and for your questions. We've got more sessions like this coming up, so do keep an eye out for those if you found today useful. Thanks again.